Good morning. Welcome back to ONV's The Financial Pillar. I'm Ryan Lepird. Joining me on the set today are my guys, JJ Foster, Terrence Bush. Welcome, guys.
How you doing, sir?
Good.
Glad to be
Great
here.
morning. Great morning. And then our special guest today, Kris Hannah with DR Financial. Chris, welcome back to the show. It's been a little while.
Glad to be back in the house.
Thank you. So today we're going to pull on Chris's expertise in retirement planning, right? That's what you do. It's one of the things that you do with DR Financial, correct?
Correct.
Yep.
Every day.
Yeah. So walk us through what that means to start planning for retirement, what it is that you do for your clients.
Well, I think it's great that we all look ahead in life. I don't think any of our goals are to work every day to the last day of our last breath. Whether that means retirement's 10 years, 20 years, 30 years, who knows? Met the gentleman yesterday, it's 103. I think his retirement's longer than I've been alive. So it's something that we need to prepare for. And the only way we can do that is make sure we have a plan in place, either through our employer or if you're self-employed, that you put a plan in place that can help you reach the goals that you need to meet. Generally about 80%, maybe 70% of your income. But if you don't plan ahead, I don't think you're going to survive financially during retirement very well.
So those numbers, 80 to 70%, that's what you're planning on needing to live off of? Whatever your income is while you're working, plan on 70 to 80% of that.
That's where I would start.
Comfortably?
Yep, correct.
Yeah, gotcha. So I guess the question I would have is, at what point in time, what age should somebody start planning for their retirement?
First day they work.
First day they work.
If they can do it beforehand, that'd be great, but kind of hard to get money from mom and dad always to do that. But, the first day you go to work, one thing you should ask is there a retirement plan?
Mm-hmm.
And hopefully you're working somewhere where they at least match something. And if they do, I always encourage people at least put enough in to get that, we'll call it free money from the employer. So that way you've got more money going in your plan than just your own. Obviously, if there's not a plan, then that's where you might have to seek outside advice from, somebody like me or even some of the banks like where you guys work at, offer to help people out put those plans together.
How often do you run into clients of yours that actually started planning from day one?
I'll say I work with a lot of small business owners. So on that side of it, I would say quite a few because the tax planning when they're a small business owner is very important. So that I think when they figure out, I want to get my taxes low, what is one way to do that? Put money in retirement plans. So they kind of go hand in hand, which is one reason why I mold my accounting firm ProTac and DR Financial Group on the investing side together, because they go hand in hand. So a lot of it is just part of the tax planning. I do also work a lot of retirees. So I'm assuming with some of the balances they come in with, they've been saving for quite a while and they've been very, very diligent. So, like I said, I think the first day of working is when you start planning for retirement, even though you may not continue working there the rest of your life. And I think it's also important that where you're at, in life, you may be single when you start working before you're married and have kids. So take advantage of those years when you don't have the additional expenses of raising a family by getting that money put away. And then you might have to draw it back a little bit while you're having the babies and the toddlers and that kind of stuff, and then circle back around to it later. But compounding interest is one of the most amazing things in life. So we got to use it.
So basically what you're telling me is telling them to do the opposite of what I did when I was young at 20 years old. Retirement was the last thing I was thinking of. I was like, I got all this time to work. I'm not worried about this. I'm worried about what I want to get today and having fun, and then family starts. And next thing you know, you're spending more money. You don't have that money to save, right? Terrence, what age were you when you started thinking about retirement, or have you started thinking about retirement?
So I was actually I'm just going to toot my horn just a little bit. I would say I was one of the more financially inclined people. So as soon as I started working, if my employer offered a retirement plan, I opted in as soon as I had the opportunity for it. Just a little prior employment history. I used to work at Walmart. Walmart did offer a 6% employee match. So I opted into that as soon as I possibly could. of course, with the end of my career at Walmart, transitioning over to where I am currently, I still have my 401k. I was able to roll that over. So I still have an existing 401k. I have an HSA as well. And I also have a pension plan as well. So my retirement is a big primary focus when it comes to my finances.
Awesome.
Boy, you about to be a catch when you get older. There's people watching this
You
like,
just say
"Ooh,
you advertise yourself right there, right?
Absolutely.
hey, I want that. That's my man. Hey, he hit on some stuff, Kris. Like he talked about rolling over his 401. There's IRAs out there, Roth, stuff like that. How do you differentiate for people, what's in their best interest as far as allocating to different programs?
Well, I think we have to break it down on the 401ks and each category. So like on the 401k, like Terrence mentioned, that comes from employer plan. I think one of the most important things is, as you mentioned, when your time came to an end at Walmart, what do I do with that 401k? That's where I see a lot of people don't know what's that next step. Generally, I encourage you that's where you work with somebody like DR Finance Group or another financial planner, where you roll that money over into an IRA. You get a lot more control of it. When you're in a 401k, you're basically just subject to wherever your former employer, what custodian they want to use, what they want to have in their plan. They're the boss of the plan, not you. So if they just leave your money in an old 401k, even though you don't work it anymore, or even roll it into a new one, I would try to get out to an IRA where you have a lot more control on what you want to invest in, who you want to work with, than just working with somebody that you're not working with anymore. Really.
Gotcha. So, speak to the tax benefits or the tax ramifications for some of the.
Sure. On the tax side, I look at it as, where are you at in your income? So when you look at your income, I believe if you're in the 10 or 12% tax bracket, I would always encourage people to make sure you get that matching money. And today's a lot easier to also get Roth money in your 401k. When I was growing up in the early years, Roth IRA or Roth 401k was not a thing. So if you're in that 10 or 12% tax bracket, I would try to get that matching money no matter what. The next thing I would do is put more money on the Roth side, meaning I would buy the taxes today. I think we'd all agree 10 or 12% is a pretty low tax bracket. Maybe you'd like it lower, but
Depending on what tax
Right.
If you're in the 10 to 12, that's pretty low.
Right, 10, 12 is pretty low. So I say if you can buy that, get your money in the Roth. Once you get into the 22, 24, I think maybe it's not 32 and 36, I think it is, or 37. Once you get up in those brackets, then that's really where you want the deductible ones where you're reducing your income by putting money in your 401k or some type of retirement planning. Because you're probably going to pay less taxes as a tax rate in retirement. So get it deferred today while your income is higher and in a higher tax bracket. We're always wanting to pay the least amount of taxes. When I'm talking to clients, I'm saying, hey, it's the same amount of money. So would you rather pay 12% or would you rather pay 10% more at 22? I mean, it's pretty obvious we'd only want to pay 12% if we can do it. In retirement. And it's not as hard as you think it is, because basically the top of the 12% bracket now is $93,000. And then on top of that, you still get about $27,000 in standard deduction. So you're talking, you can be pushing almost $110,000 in income and still be in the 12% bracket. So, it's not too shabby, to still have that kind of income, especially for ex-married filing jointly numbers. Too,
So understanding the pros and cons of each one is extremely important when deciding which way to go, right? Yep. So, but I want to go back real quick to, you were talking about 401ks, and I always like to break things down kind of in layman terms of what that means. Because a lot of times when I'm speaking with people, they just think retirement is 401k, right? Which a 401k is a employee-sponsored retirement plan. It's a program that they put together as a benefit for their employees that allows them to contribute to this. And in most cases, they match it, right? There's a match involved there, whether it's 100%, 50%, 25, whatever that may be. But with the 401k, as Kris was mentioning earlier, you are limited to the investment options that they have in there.
Correct.
Whether that's 3 or 4 options or 6 options or something like that. So when talking about you leave that job and taking possession of that, when you leave that job, it's typically more beneficial for you to take possession of that, roll it over into an IRA with a financial firm like DR Financial, right?
Correct.
Which allows them to then in turn be able to tap into all the different investment vehicles out there, stuff that may grow more for you or stuff that may be more in your risk tolerance, right? Typically 401k, and you can correct me if I'm wrong on this, Kris, but typically 401k retirement plans are usually more on the conservative side of things. Would you agree?
Yeah, I think they can be watered down some because most of the time you can't buy individual stocks except for maybe a little bit of your employer, employer plan. So yeah. Right, so of course we may be forced into the 401k plan because our employer won't allow us to get outside of it, right? Mm-hmm. Although some of the plans once you get to age 55, actually you can pull your money out of there and get it over to an IRA and get a broader, like you said, investment plan.
So a lot of companies' 401k plans will allow you to
even if you're still
prior to retirement or leaving the company at a certain age.
Right, but you have to look at your plan because there's many plans. I have clients that have done that, and I have many clients that their plan won't allow it. So, basically, any employer can make their own rules in that plan, whether you can or you can't do that.
So now when you take possession of that 401k and roll it over, that's when you're opening an individual retirement account, which is an IRA, which then in turn you have an option of a traditional IRA or a Roth
if you want to pay the taxes, correct.
Right? And the difference on that is, why don't I let you explain the difference between traditional and Roth when it comes to taxes?
Right. So on Roth IRA, when you put your money in, you're paying the taxes today before you put the money into the Roth. So again, that's why I said earlier, if you're in the 10 and 12% tax bracket, that's why I go ahead and pay your taxes, put it in the Roth. It's going to grow tax deferred. And then when you take it out after retirement at 59 and a half, you can pull it out tax free. So basically it's going to grow the whole time you're in there tax free. Nice thing about Roth IRA, a lot of people don't know, is that, you put your money in there, that you can pull that money that you put in out at any time. And no tax liability because the government IRS says your money that you put in is the first money that comes out. So that's why I encourage a lot of young people to do the Roth IRAs because, especially when they're in their early years, not making as much as they do in later years. Because I did that, and back when I did it, the limit was like $2,000 a year. Now it's like $7,000. That'd be nice.
So that's the maximum that the government will allow you
put
to
in there.
Contribute,
unless you're over 50. 50. Then you can put a little bit more in. I think maybe 8. So what I did is I put I had about 10 grand in there, and of course that was up before 2008. So my 10 grand grew to about 20 in a few short years, and luckily got one of my first houses in 2005 before 2008, and I said, okay, I'm gonna pull my money back out. So I pulled my 10,000 back out to put down on my house. So I like money that I can use for two different things. A lot of people want to put their money over in savings. They want to put it in the Roth IRA, and they just think Roth IRA, retirement, savings over here for other things. I'm like, no, I want to use it here because I don't know when I'm going to buy my first house. And that's the great thing I can do that. You also can pull money without penalty.
Great information,
for that too.
Especially for somebody that's in their younger years doing that maybe isn't established with the house yet, is to understand that up front.
So that's
contribute. It's great for you to start planning for retirement, but don't start contributing money before you start accumulating your assets.
Yeah, so I was able to use that dollar for two things. One, I was able to increase it from 10 to 20, right, for my retirement, but I was also able to get that 10 back out and put down on my house.
Now, real quick, is there a caveat to that with the Roth where you can take it out as long as it's over 5 years, or is it from day one?
No, it's day one.
Okay.
If it's your money.
If it's your money.
So you just want to kind of keep track when you put money in a Roth IRA, how much you got in there. Hopefully your custodian's figuring that out too.
So if you're hitting the point where you're actually starting to withdraw more than what you put in, then
you pay taxes. And a 10% penalty.
10%. Okay. Gotcha.
So a traditional IRA means I'm going to save on my tax return now. I'm going to get a deduction for, like to say, my $7,000 I put in there and not pay taxes on it today. Get that deduction, lower my tax liability.
That's what we call pre-tax money.
Pre-tax, Yep. It's going to grow tax deferred. So that means you're not going to pay any taxes while it's growing. And then after 59 and a half, otherwise have a 10% penalty. When you pull out, now you're going to pay taxes on whatever bracket you're in that current year when you pull your money out. So that's when you have to be careful when you're pulling it out.
And kind of the general idea behind that for most people is that when you retire and you're not working, your income is less. So therefore, you're probably going to be in a lower tax bracket than you are when you're working. Therefore, when you start taking that money out, you're paying the 10, 12% rather than the 24% when you're working. Is that kind of like the idea behind that?
That's correct. Yeah, we actually have a name for it. We call it the IRA Rescue Plan, where we're working with our clients. Again, because I have the ProTax, the accounting firm, working side by side. We're looking at your tax return and saying, hey, in retirement, now we know this IRA money is going to be taxable, and we have to look at Social Security, or if they're still working, or pension plans, or other money coming out, and saying, hey, I know you don't need this money right now in retirement, right? Because maybe they don't need as much, or they're in good shape. Why don't you go ahead and pull out that another $15,000? We'll get it taxed in the 12% bracket, which we all would say still good, and then turn around and reinvest it, somewhere else if we need to, or spend it. But now we're getting it taxed at a lower bracket rather than not pulling anything out, waiting for 4 or 5 years, and then saying, hey, I want to pull out 40 grand for a new car or whatever else. And all of a sudden now that 40 grand puts you in a higher tax bracket. So the money that you could have taken out over 2 or 3 years, now you're pulling out one time and you're paying 10% more in taxes than you ever would have before on that same dollar you have.
There is one other, we've mentioned a couple of times now, pension. So talk to us about pension, because our older listeners are probably familiar with that. Our youngers probably aren't, simply because 401ks are the more popular plans now than pensions, but there are some places that still offer both. Tell us what a pension is.
Right. Yeah. So at some point, the government or the minds that be out there and everybody kind of decided, hey, it's better that the employee has control of their money than the employer, same for retirement. At times, I'm not sure that's right or wrong. Because if people don't pay attention to save for retirement, they don't have very big retirement. When you had a pension plan, that pension plan, the employer was putting money away for you and waiting until your retirement time. And then they would provide basically a monthly income to you that you never had to invest, plan. You couldn't roll out to anything else. You were subject to whatever income limits that fund would pay out every year. So if it said, hey, I'm going to pay you $3,000 a month or $2,000 a month, that you're not getting any more or any less, and not always do they have a cost of living adjustment either. So you're pretty much having to just budget that in your income, and hopefully between Social Security or other retirement money, you can make it.
Gotcha.
But at least you didn't have the pressure of losing it. Now, I mean, as we all know, many employers had those plans have gone underwater and went bankrupt, and then that money got into where the government had to help out and do control. So it would make people a lot nervous because you weren't in control of your money. So there's kind of good and bad on all that. It's probably best that we all can control our own retirement money.
Yeah.
Along them lines, so, Terrence gave the example. He was at Walmart. He had his 401, and he rolled it in. So do you recommend, or that I leave my employment, I roll it into my current employer, or do I take that and I get with the individual financial advisor and I manage that and keep my new employment? Which is there a better strategy, or what would you recommend?
Well, I believe in freedom. So I think if you have your old 401k, that you roll it over to an advisor like myself, or a planner like myself, or others that can help you manage it on a more individual basis. Because you got to remember, you're kind of limited in most 401ks to mutual funds or some kind of bond fund. So kind of like Ryan was saying earlier, you're not getting the whole plan of options out there that you could use to help save for retirement. When you get with individual planners, now you can get more easier into the stock market and have somebody that can help you manage that. Or if you want to risk it yourself on, one of those private platforms.
Some day trading with that.
Day trading, right.
Big fan
Or
of that.
you can get into the other side where like you have index annuities where you can make money when the stock market goes up, but when the market goes down, you don't lose any money. So now you've taken your menu of items from just a little bit to whatever's pretty much available out there in the market. And I think that provides us, my retirement experience and needs that I have are going to difference from Terrence and get a difference from JJ and Ryan. And actually because I'm never going to see a pension. Terrence will. JJ may have a whole different experience that he needs for retirement. So I think they need to be more individualized plans and really
tailor it to their individual needs.
And what
rather
their,
than
and what their
encompassing
future needs
the
might be.
whole group
Right.
plan. Right.
And tailoring it to their individual needs, how do you determine? I know the first thing a financial advisor says is, "Hey, what's your risk level? You know, where are you at?" How do you determine that? What is, you know, what is something that somebody needs to determine what their risk level is? I have no idea.
Still in my thunder there. So one of the first questions I ask my clients is, how much money do you want in the stock market, where you can have the risk and the gains, right? And how much do you want safe, where you can't lose any money? And when I use safe, I say I don't look at bonds as safe, because depending on the interest rates, you can actually lose money in bonds if you sell early. I use index annuities, and they have their upsides, which I like, and they also have their little bit of a downside, but so does every investment, and cost and risk. So one thing I say is, okay, take 100 minus your age. If you don't know how much risk you want to take, some people do. A lot of people don't, and they'll say, okay, so if you're 50 when you come in my office, that means 50% of your portfolio could be at risk in the stock market, mutual fund stocks, and 50% should be safe, CDs or index annuities or something like that, where if the stock market goes down, you're not going to lose all your retirement. Nothing would be worse than, 2007. Hey, I'm retiring in 2008, and,
you lost half your plan.
Right. And now all of a sudden you've gone down 50% in your plan, or 40%, which is pretty devastating. Now you're working for another 4 or 5 years, or your retirement a lot less. So as you get older, now you're 60, let's say, 100 minus 60% of your portfolio should be safe. 40% would be at risk. So that way, the older you get, if there's a big market downturn, which, one of the things I tell clients right now is, would you buy gold or real estate at the highest levels, highest price? What would you tell me? Would you buy gold or real estate at the highest price?
No.
I say, yeah, they both maintain their value throughout the year.
But not always. I mean, not always, right? So you sound a little more risky to me. Great. But many of my clients would say, no, I would not buy gold or real estate at the highest price available. Well, then when we look at the stock market right now, we're at the highest point of the stock market. Very risky. But, that's why when people ask about the risk ratio, like you do, that's why I love people like JJ here, because I don't determine that number. I tell them, I'm not here to determine that number. You're here to determine the number, because I don't know what your risk level. JJ may say, hey, I'll put all the chips on the table, and say, hey, I'd rather be 80% risk, 20% safe. I'm comfortable with that. I'll handle the safe investments. I got a broker friend that will handle the risk, and we manage that, because it's your retirement and how you want to invest. If you ask me my opinion, I'll say just use 100 minus your age. It's a very fair spot. But I've had clients come in and go the other way, where they're 50 and they're coming and going, I only want 20% of my money in the stock market because I don't like the risk. Yeah. Great. We can tailor a plan. So that's the advantage of working with somebody like myself who's independent, is that we can really tailor a plan versus just, if you just go throw your money in a 401k all the time in the mutual funds, that's where it can be a little bit tougher to have a tailored plan.
Talk about navigating the system. I mean, now that's funny when you talk about putting funds in the stock market versus 20, 30 years ago, something you would have told somebody. I mean, speak to that. What are some, you had to change up your strategies.
Yeah. So, I mean, there's a lot more investment tools these days than 20, 30 years ago. I think the products are better to help save for retirement. So again, I think that we're working with an individual rather than just somebody blindly at a company can really help you tailor. So your people are using, I use life insurance sometimes as not only for if somebody would pass away, for their family, but also for investing. There's ways that you can use life insurance now that you can overfund a policy, put more money in there, and now you can draw it out like your own bank. And you can pay it back at very low interest too. But you can kind of create your own bank where you're not, sorry for the guys that work at banks, but you can kind of control, a fund that you can pay back yourself and use and create it tax free. So, you can use tools like the mutual funds, the stocks, index annuities, the life insurance policies. There's just many tools that you can use that, and people can, as Ryan said, day trade. I mean, if you're more that independent person saying, I don't trust anybody, great. You have that option. You can use day trading platforms.
Or you don't got to go 100% in. You can take a percentage of it and have somebody manage it for you. Then you have your play
Right.
money, right? That you do, and maybe that helps. I've done that in the past to kind of help myself understand and learn the stock market, because most people are going to get into it and make mistakes till they understand. Do you want to make a mistake with all your money, or you want to make a mistake with a little bit of your money?
And that's what I suggest. That's what I do myself. I have some money in index annuities. I have some money in the stock market, and then I even have a little trading account over here that I get to play with. That sometimes I do a great job and make a lot of, and sometimes not so great. But I'm not putting all my eggs in one basket, as Ryan's saying, and I think that's part of the key.
Diversify. Right?
Diversify.
Yeah.
Yeah.
Now, he's brought up day trading, and we know that's big. People want to, do that. They think it's, that's the latest, greatest. But again, you have to watch it and be on top of it. Speak to what is your fee? What is a financial advisor's fee? Because a lot of people, there's a misnomer out there that I can't afford a financial advisor, or why would I pay somebody and I'm gonna do it myself?
Right. I can speak to some of that. I'm not a licensed broker, so I can't get into all the details of that. I'm insurance licensed. So, there's pros and cons to every investment. Like on the index annuities that I use, there are no fees when you go in. There's no fees while you're investing, and there's no fees coming out. All they have generally is a surrender charge. It can be, the most is usually about 10 years, but it can be less than that. And if you think about it, 10 years, 1 point sounds, well, that sounds like a lot. Well, but if you are having your money when you're in the 30s, 40s, and 50s putting in there, a lot of times you're not even retiring for 10 years. And that surrender charge starts at about 9% and goes down to 0. And all that means is if you take out more than 10% of what's in your index annuity, that the company's going to keep some of that money. Now, again, most time plans I'm putting together, I'm looking at their situation and where they have all their money and saying, we can put it in there because I truly don't believe you're going to touch your money for that 10 or 7 or 5 years. And majority of my clients never do, because I try to put a plan together that you don't hit a surrender charge. So for like some of that meets with me, I don't have any fees. So as JJ says, hey, there you go. That's a very easy low entry that if you're worried about fees. Now, when you go to a broker, they will either charge, and kind of like a quarterly, or I would say like an annual fee of a certain percentage, and it can range anywhere from, 0.5%, maybe up to 2%, depending on how much you have invested there. That's not bad if you're trading a lot or your broker's trading a lot. Some say, hey, we only do better when you do better. I've heard that term out there. So, the more that the broker makes you, the more they make, the more you make. I'm okay. I can live with that. Sometimes though, if you're doing other things, then maybe you just want to pay the upfront fee on the front end, and when you buy or trade, and not have to pay it on the back end, and that's different. So if you're meeting with a proper financial person, they can really tailor their plan to what you feel most comfortable with. And that's what you're getting a great advantage of outside the 401k.
For somebody asking that question, is like, why would I pay somebody a fee? You're paying them for their expertise.
Yes.
Right?
Yeah.
They have knowledge of something that you don't. So if you're paying them a 1% fee, but they're returning 8-10% or more on it, right? You're still up. Now, I don't think anybody can legally guarantee, right, a return, but they can show historical numbers of this is the typical returns that I get from my clients, right? So you're basically paying for the expertise, just like you are in taxes. We can all do our own taxes, right? But we might be leaving money on the table because we don't know the laws.
Yeah,
right?
I totally agree. I mean, one of my things I would say, we can all do our own oil change.
True. I'm not doing it.
Yeah, and you're never going to see me underneath the car doing the oil change. I don't even want to try to do the oil change. But that's why everybody has businesses and jobs, because we all could probably do everything that we all do. I can help teach or coach a basketball team or work in a bank. I could do all that, but I don't always have the time or the desire to. Yes. So I have to trade my money for Terrence's service or Ryan or JJ's.
So somebody out there that's looking, right, we're giving them the information, encouraging, looking for a financial advisor to kind of help you with that. What's a good way for them to go about choosing a financial advisor, right? When they're talking with them, what should some things they should look for?
Well, one, I think the referral method is best. Like my companies, we really don't advertise. I've been in business for, 23 years, and we hardly ever advertise. It's all word of mouth. And I think that's probably the number one thing how I find somebody would be to talk around and ask your friends who are they working with, who do they know, and has it been a positive experience or a negative experience, or yeah, you're not going to end up in my office always. I mean, I wish people would, but not everybody knows me in Fort Wayne. I mean, I just met Terrence today. Now maybe he'll show up in my office, but I think a referral is the best thing. It's kind of like when we go out to eat at restaurants or anything else. We say, hey, did you go over and eat at this place? And you're like, oh, dude, it was awesome. And now you go. Or they say, oh, no, it was the worst food ever. You're probably not still showing up at that restaurant. And it's easier on my end, too, because I know if somebody's referred you, I think it really helps the community and helps your friendships and how you work with clients, because it's like, hey, I've done a great job for this client. It speaks volumes for the service I've provided that client, that they thought so highly of what I've helped them, that they felt very comfortable to tell their friends and family that I've been very helpful. And it makes that conversation a lot easier, because you're not really having to overly introduce yourself and think that somebody's going to blindly trust you on that. It's like having your first date. It's a lot easier if you know the person before you start dating somebody than just dating somebody out of the blind.
A financial advisor should be a trusted advisor, right? So that's what I always tell clients or somebody that's looking for financial advisor, is that same way I do with a bank, right? There's all sorts of banks out there, and bankers. Interview them, right? Because you got to be comfortable with who your financial advisor is going to be. You have to trust them. If you don't fully trust them, you're probably with the wrong person, right? Going back to this from my experience, when I was at my previous employer, I had a client, her financial advisor that worked for us had left. We always thought she had a great relationship with this individual. When she left, I had to schedule an appointment for her with the person replacing him, right? Which I knew this connection there probably wasn't going to be the best connection, but because of how we did things, I had to schedule that appointment with him. In talking to her about how she felt after that, she was kind of hesitant. I could sense some she was keeping something from me. So I was just blatantly honest with her. Like, if you're not comfortable with this individual, it's nothing personal. It's just business, but you need to tell me, because we want to make sure that you do get with somebody that you're comfortable with. Because if not, we ultimately know that you're going to leave us altogether and go find somebody else. And ultimately, that's what it was. She opened up and told me exactly, nothing he did wrong, just she didn't have that connection with him. I knew that somebody else within our firm probably would have a better connection with them, just knowing them. And first appointment, he uncovered another $3 million that she had never even told us about and got it over, right? So when you have your financial advisor, interview them, find out about them. You have to be comfortable with who they are. And if you're not, just be honest up front and find somebody that you are.
Right. And I think it's important, because I don't think the decision should be based upon, who has the nicest building as an advisor, or who has or the highest cars, or nicest cars. I mean, there's something to be said of that. But on the same side, if I have the best building in the world and the best car in the world, and I'm your advisor, are you spending too much money? So there's something.
Your own money.
At the same token, you shouldn't be meeting a financial planner just in their car because that's their only office space. It goes both ways. But I think that referral is really the strongest way to talk to somebody, interview somebody, and see if you're comfortable working with them, because obviously your friends or family have been.
Yeah, absolutely. So running short on time today, but last question I have for you, Kris. Election year. Everybody's always talking about election years and the markets and how the president's going to determine that. What's your thoughts on that?
Well, I think election years are generally decent years for the stock market, at least up till the election, because usually the parties in power don't really want the stock market to go down before an election. It's kind of a death knell on their economic agenda.
Absolutely.
Before November, was it 7th this year, 6th? I can't remember what day election day is, but I think the market will hold. After that, I don't know. It depends on who wins and what people think. I don't know. So I would be very cautious coming out of the election day. I think up until then, we're probably fine, but, things can change. But, I think more what happens next year, once whoever's president is in the office, is where the real changes will come from, because then, policies are starting to be laid down and votes will happen and things can change. So you definitely want to be prepared. I don't think you want to just go blindly into the election and have all your money sitting in the stock market. Again, it's about diversification.
Mm-hmm. Gotcha. Gentlemen, any other questions for Kris before we get out of here today?
Mr. Terrence, you got anything?
As of no, Ryan kind of stole all my questions. So
Maybe that banker thing, we're on the same page.
right,
Sorry.
definitely on the same
We'll have
page
to get
with
some
that.
signals going next
But-
time. Like,
Yeah, I was just
Let me
I
jump
was
in
like,
here.
Well, I
okay,
appreciate
great.
Terrence's story in the beginning because that was a real life story of having, pension plan, retirement, trying to save, and that let us really have a great conversation today because that really just kind of laid the path out there. So I appreciate that.
Just to throw this out there, my employer actually does give me the option to choose what I invest in. And of course, with me being younger, I do typically invest more aggressively because I do have time to make that back. Just a little insight. I have been averaging around 10 to 12%. So
very good.
pretty good with that.
And I'll add real quick to that because, too, if you work with an employer, I think it's under 100, they can actually do a simple IRA as an employer plan versus a 401k. That usually you have a lot more options, possibly less fees. So a smaller employer has a little more options. So that can help, too, as well. They don't always have to do a 401k.
Gotcha. But go ahead, Jay.
Now, I was going to say, I'm calling Kris and Terrence after this interview. I'm going to stay in touch and get these tips from you guys. So
Absolutely.
I appreciate it. But I don't have any questions for Kris, but I would like to remind everybody, coming up this month, 1026, the third of our financial literacy, a mental state of mind, will be taking place at the Fort Wayne Urban League this week. We're listening to our fans, and everybody has been, by unanimous decision, folks want to hear about credit. So we've been sitting down. You're going to see my two co-hosts. They're going to be there helping talk about credit. We've actually already been planning. So we're expecting another great evening, great conversation, food, fun, and a lot of knowledge. So hope to see you out there again, 4 o'clock to 6 o'clock, 1026 at the Fort Wayne Urban League.
Awesome, JJ. Thank you. Thank you all for joining us today. Thank you, Kris, for coming to talk to us about retirement.
Great to see you again.
There's also a lot of information around that, but the moral of the story is start planning for it from day one of working, right?
Definitely. Clients always say, when should I start investing and how much do I have to have? Today and $1.
Today and $1. Awesome. Great way to take us out. So I'm Ryan Lepird, JJ Foster, Terrence Bush. We are ONV. Till next time, peace.